before we begin, let me ask you a question. What would you do if the IRS suddenly allowed you to deduct 4 times more of your state and local taxes this year? Would you celebrate, plan ahead, or quietly wonder if you missed something? Because here's the truth. In 2025, that's exactly what's happening. Hi everyone, I'm Mia Taylor, enrolled agent and owner of Mia Taylor Advisors. And today we're diving into one of the biggest tax changes that is here that will allow you for your 2025 to make some adjustments. And the brand new expanded SALT deduction could be the one thing that's going to save you thousands of dollars. If you know how to use it, great. But if you've been stuck with paying that $10,000 SALT cap, this is your moment. Let's get into it. First things first, SALT stands for state and local taxes. And these are taxes you're already paying every single year. Things like your state and local income taxes, that comes off your W-2 or what you just have to pay in quarterly estimated taxes, your real estate property taxes, your personal property taxes, or your general sales tax if you elect to deduct those instead. Now, for years, taxpayers have been stuck with a hard $10,000 limit. Didn't matter if you paid $20, $30, or even $40,000, you could only deduct $10,000. But 2025 brings a huge change. Let me tell you what Congress is giving us for this coming tax season. A brand new SALT cap of $40,000. That is 4 times higher than what we've all been stuck with since 2018. And if you're married filing separately, unfortunately, you're only going to get half of that. So that's only going to be $20,000 for you. Now, before everyone gets too excited, there is a phase down rule for high income taxpayers. I'll break that down in just a moment. But for millions of people, especially high W-2 earners, homeowners, folks living in higher tax states, this is a game changer for you. Here's how the phase down works. If your modified adjusted income is over $500,000, not your W-2 wage or gross wages, modified, your SALT deduction of $40,000 begins to shrink. The reduction is 30% of whatever you earn above $500,000. But, and this is important, the SALT limit can never drop below $10,000. So even high income households still get the same deductions they've had for years. You're not losing anything. You just might not get the full $40,000 benefit. So let's use a quick example. If your modified adjusted gross income is $600,000, you're $100,000 over the threshold. 30% of that is $30,000. You take the cap of $40,000, you subtract your phase down of $30,000 equals your $10,000 final limit. And remember, $10,000 is the floor. So hopefully that's a good example of like what it looks like if your modified adjusted gross income is north of $500,000. And modified, we can get to that later. Now, let's talk about what actually counts towards the SALT cap. What's included, okay? State income taxes, local income taxes, real estate property taxes, personal property taxes, or state and local sales tax if you choose that method, okay? Now, what's not included? Foreign real property taxes. Those are fully disallowed in 2025. Investment or business related taxes under Section 212, certain local assessment that improve property value, those are not. So if it's personal, it's just not going to be part of it. And here's a nugget of gold for my business owners. Business taxes fall outside the SALT cap. That means things like gross receipt taxes, franchise taxes, certain business privilege taxes. Those don't hit your SALT limit at all. And that is huge because those are deductible on your business. And we'll get into that. Now, and for my LLC partnership and S corporation owners, yes, the PTE, this is the pass-through workaround, that all still stands. When your entity elects to pay state income taxes at the business level, here's what happened. The business deducts the tax fully. Nothing hits your personal SALT cap. You get a credit or an adjustment on your personal tax return. This continues to be one of the most powerful tax strategies for high earners, and it's alive and well in 2025, okay? Let's make this real. Let's say in 2025, you pay $18,000 in state income tax, $12,000 in property taxes, and $1,500 in personal property taxes. Total SALT paid $31,500. Now, under the old rules, you could only deduct $10,000. Under the new 2025 rule, your full $31,500 is now deductible because it's under the new $40,000 cap. Let's look at the tax savings of that. So let's say you're in a 32% marginal tax bracket. Your tax savings would be $21,500 times 32%, which would be $6,880 from one rule change. And that's why tax planning matters here. So what can you do right now to maximize this new rule? Well, here are your next steps. Review your property tax estimates, especially if you own multiple homes. and that's personal homes, not the ones that you have in place for service as investment. Reevaluate your itemized deductions. Many taxpayers who've been stuck taking the standard deduction may finally benefit from itemizing again. That's really good. If you're a business owner, check your PTE election. That's right, you need to talk with your strategist and look at your PTE elections. This can shift tens of thousands of dollars off your personal return onto your business return. Pay attention to the timing of tax payments, especially if you're buying or selling property in 2025. The bottom line is this: the new 2025 SALT deduction gives taxpayers, especially high earners, a real opportunity to lower their tax bill. But like everything with the IRS, the benefits goes to the people who plan, not the people who wait. If you want help understanding what your SALT deduction might look like for 2025, or if it's time to start tax planning proactively, my team and I are here to guide you. Don't forget to like, share, and subscribe with someone who needs this information or needs to hear it. And I'll see you in the next video. Take care.